be safe in saying right now we're living through a period of uncertainty and volatility. I think what's surprising to me, though, is why is that not impacting economies and markets more so? And last year at this time at AIM, I mentioned how over the previous 5 years, we'd gone through a number of these really big events, things that we hadn't seen in 50 or 80 years. If you think about COVID and the level of tariffs that we had, the Ukraine war, and then the run-up in rates. And it was really a driver of the liquidity challenges that we have in the market and a bit of the pricing gap between buyers and sellers. And I think in a sense, this year is no different. We've got a continuation of more big events. We've got the US-Iran war. We've got an oil price shock. And of course, the AI threat and opportunity is now upon us. So I think to me, it leads to two big questions. Why are so many of these big events happening? And why are we not seeing more impact? And why don't they seem to matter more in our markets and economies? And I think the answer to the first question is really, when you look back and step back, these big forces that are at work and are really driving some of these big events that we're having and seeing almost on a recurring basis or an annual basis now. And Catherine mentioned we've got a lot of shifting in our geopolitics, bit of upheaval going on, and some would say the post-World War II order is breaking down and we're moving to something new. And we've seen it through the US and China rivalry, where we're getting trade tensions and tariffs coming out of that situation. We've got two different military conflicts going on that have both led to supply shocks. Our politics are as polarized as ever in various countries, and it's making it harder to get big things done. And we have the unstoppable growth, it seems, of government spending and government debt and just leverage in the system overall. And then, of course, now we're throwing on one of the biggest technological changes we've ever seen with AI. And I think, in a sense, these forces seem to reinforce one another and impact one another. So, for example, our political polarization makes it very hard to solve our fiscal deterioration. And I think for as long as these big forces are at play, we're going to see more of this volatility, more of these events in the years to come. That backdrop is driving a higher level of uncertainty and declining consumer confidence. You can see it in the charts on the left on this page. We have a heightened level of economic uncertainty, and we've got declining consumer confidence. And in fact, in the US, we just hit the lowest level of consumer confidence in a survey that we've been measuring back to 1952. And I think that's been driven by a number of things, but certainly the economic proposition just isn't the same. We've got K-shaped economies and recoveries going on in various markets, and that's creating a lot of angst with the electorate that's out there. I think that's also creating a challenge a bit here for the central banks. So we entered this year thinking, okay, we've got sluggish growth. We're now going to get some rate cuts. We've been through a lot of the rate cut cycle in Europe. Now it's time for the US to cut rates. We started that process late last year. We're expecting, in some cases, 3 or 4 rate cuts this year in the US and possibly at least one more in Europe. Instead, now we have the return of inflation, and that's leading to a bit of a challenge for central banks, and they're a bit on pause now on where to go next. And at this point, I think the expectation in the US is maybe we get a cut this year, but rates may stay flat, or there's even some talking about an increase, which they are discussing as well in Europe. So we're in a bit of a wait-and-see mode here. Surprisingly, though, given all of that, we're seeing a lot of resilience in the economy and growth, and we're seeing a lot of resilience and actually strong performance in public markets. Growth, while sluggish and not exciting, is still actually held up pretty well. You can see the chart on the left, which shows projections for this year, which really haven't changed much in the last 6 months, which is a bit surprising given we've had the introduction of the Iran-US war and the oil price shock that came out of that. Corporate earnings also are still pretty strong. In the US, we've seen the 12-month forward earnings projections actually accelerate. And we've seen really strong public market performance in a number of places in the world, and no more so than the S&P 500, which now is trading at close to an all-time high from a valuation standpoint. So essentially, we have this bifurcation. We've got a lot of these big forces creating uncertainty, declining confidence, questions about growth, what's the central bank going to do, yet we're seeing the markets actually hold up really well and the economy hold up really well, which is leading to the second question, which I think can be answered by really 2 things. One is AI, which is having a lot of impact on markets, and 2, all the liquidity that's still sitting in the system and all the stimulus that is being injected by governments. If you look at this chart on the left, you can see really strong performance in the S&P from the Mag 7 and more recently semiconductor companies really driving the market forward. And you can see an upward to the right but more sluggish performance for the rest of the market. And there's good reasons for that. You can see in that second chart on the left, the earnings from the Mag 7 is far outpacing the rest of the market. These are historically incredible companies, of course. And there's a real narrative building now in an AI productivity boom, which should help propel earnings for the rest of the S&P 493. But we've also got significant liquidity sitting in the system. So you can see in that third chart, public debt and deficits continue to increase. For advanced economies now, they're well over 100% debt to GDP, and emerging economies are well on their way to those levels. We've also seen growth in the money supply. So in the US, it really exploded during COVID. We had a little bit of a dip, and now it's back growing meaningfully again. So we've got really stimulus happening from both places. At the same time, we've had elevated corporate earnings now for about a 10 to 20-year period, and some economists would suggest that that stimulus is finding its way into corporate profits, which is also helping support markets.